today is about money management and investing, right? And specifically for PhD students. So hopefully by the end of today, you're going to have a good idea of, I guess, the recommended habits to implement in your day-to-day lifestyles, and also how to get started with actually investing for yourselves. So, as Medea said, any questions that you do have, just pop them in the chat and I'll try to get around to them. Now, just to give you a bit about myself and really why I'm coming today to give you the advice that I'm giving you. So, I'm a senior financial advisor at Belvedere Wealth Management, and I've had an interesting journey. So, I've been in financial services for 10 years. So, essentially, as soon as I graduated, probably like most people, the first thing that came to my mind was how do I make as much money as possible? And actually, financial services was the first thing there, and I started my journey in trading. So I was a forex trader. After a few years trading, I became successful, I guess profitable, I should say. And I realized that making money or having an income was only half of the job, right? The other half of money management is money management and how you manage that income. There's hundreds of people, and I speak to people every day who have high incomes, but they still struggle with achieving their goals and a struggle with sort of their personal finances. And as a financial FCA regulated advisor, they come to me for advice. Also, in addition to money management, what led me down this career path is growing up. I sort of grew up in South London, typical sort of South London upbringing, single parent household. I wasn't given any financial advice. No, no one was there for guidance. My dad is Nigerian, my mom is Malaysian. And so it was an interesting cultural dynamic, but still there wasn't any sort of guidance on what to do once you make money. I studied at Warwick Business School, and probably similar to yourselves at university, I struggled myself. Um, and that sort of led me to have that passion to say, actually, in my network, I wanted to be that person who was able to give people advice and help them really understand how to make money work for them rather than always constantly chasing money and working for money. So today, hopefully that gives you a bit of background, but what I want to sort of focus on is the reality of money for students. We're going to discuss a sort of case study or scenario that we can refer back to as we go through the slides. We'll look at key habits, things that you guys should be doing, that really going to help you focus on reducing the stress and financial anxiety. What is investing next? Now that this next section is really going to be focused on practical steps to take and what you need to understand before you get started. So we look at investor trends, common mistakes, and then actually what, following today, what you should go away, research, and do in order to start your investing journey. So I do hope that you find this practical and useful. I don't want you to walk away from today just with a bit of information. I want you to be able to actually take actionable steps. So yeah, let's get started. Now, the reality of money for PhD students. Okay. It's been a long time since I've been at university, so do excuse me if some of these figures are not exactly correct, or you don't feel that you relate to this, but hopefully we're not too far off. Okay. And we start off with income, right? We've got modest stipends. On average, from my research, we're looking at 22,780 per year. Give or take, it could be higher, it could be lower. So it's not a great deal of income. Now, this is actually below the average income in London. So we don't expect, people to be able to save huge amounts on this. Second thing is that some of you will have families, children to take care of. So there's going to be even further financial pressure to deal with. And potentially, that means that you might have to work part-time. Now, unless you come from a rich family where you actually, all of your expenses are taken care of, these are things that you don't have to worry about, then, you're probably going to relate to those things I've just mentioned. Now, The reason this is important, or today is important, is because that 70% of postgrad students report that they have financial stress. Okay. And this impacts their performance, this impacts their studies. So today, really just focus on taking away things or small sort of solutions that you may be able to implement to reduce that, and so that you don't fall into this trap. Now, imagine this is, typical scenario. Jeffrey, don't ask why I chose that name, but Jeffrey's 32. He's a PhD student based in London. Currently, he takes home 1,700 per month. That's either from his part-time work, family support, or a stipend. What we would expect is that of that, he would spend 90% on his living costs. So rent and bills, £900. Transport, £300. Food and entertainment will be the remainder. Now, this is going to vary from person to person or situation, depending on what you prioritize. But typically, we would expect 90% to go on that. What's left? Disposable income. So he's got £170 left over, 10%. Now, when it comes to budgeting or being aware of your finances, there's something I like to refer to as regular, irregular expenses. And we've said this session is specifically for PhD students, but in reality, and I speak to people from all age ranges, 25 up to sort of 70, 75, all sorts of income levels, all sorts of asset bases. One thing that a lot of people miss when it comes to budgeting or managing their expenses is the regular, irregular expenses. And you might be wondering, what does that mean? But there are many expenses that we don't actually account for because they're not every month, but there is something of that sort every month. And that could be some, whether it's the dentist, parents' birthdays, whether that is an emergency Uber because, you're carrying extra luggage. There are all sorts of things that pop up every month that we need to make sure we're taking into account. So how do we manage this? This is what our base is. How do we actually manage that? Now, there we go. So now the key habits for survival. And I've used the word survival because we're not expecting ourselves to start, achieve financial freedom. The reality is you cannot budget your way to wealth. You invest your way there. And the purpose of the survival stage is how do we manage or maintain stability while we're at low income levels? Once, as we expect, you graduate, you start a career, your income increases, then you will focus on implementing sort of wealth building strategies. Now, these four habits that you see in front of you are very key and essentially are going to lay the foundation for your financial planning or for your personal finance. So many of you probably do this already, or you've looked into it, or if you haven't, then definitely need to start. But budgeting. Now, I want to talk to you about actually how to budget and what you need to do when you budget. So there are now apps like Snoop, Emma. If you're more old school traditional, you can just create an Excel. But budgeting is not something you do once a month. I recommend to my clients they spend 30 minutes to 60 minutes per week on this, just being aware of what they're spending, tracking where money has gone, tracking what money's coming in. This will vary depending on the level of transactions you have. So I specialize with self-employed people, so naturally it's a lot more time consuming. But the purpose of this is to be very clear on where your money's going. So many times I hear people say, I earned X amount this year. I've done X amount. I don't know where it's all gone. I should have had this, but I'm not sure where it's gone. And as soon as I hear something like that, it's a red flag immediately. You've earned money. You should know where your money's gone. It's important. Some people say money's not important, it doesn't matter. But after oxygen, I think money is highly ranked up there. Now, The second thing you need, a savings buffer. You would heard this referred to as an emergency fund. Okay. What we typically say as a FCA regulated advisor, we sort of recommended to say 3 to 6 months. So 3 to 6 months of your living costs. Now, if you're spending 1,700, so it's 3 to 6 times that amount. However, on a lower income, this is probably unrealistic amount of savings to build up in a reasonable amount of time. So 500 to £1,000 is what you want to always have in your bank account just for emergencies. And typically, as a student, most emergencies will fall under this amount. The third thing is automate your essentials. Okay. What this means is that set up standing orders so that, and whether it's going to be into separate accounts, but set up standing orders that automatically take money out of your income to cover food, travel, rent, bills. A lot of the time, we don't automate these things. And then we spend that money, whether it's going out, we spend it on the emergency stuff. And now we have to borrow money in order just to pay our rent. We have to borrow money to pay our essentials. When in reality, the essentials should have been covered. Number four. Now, again, this is not something that's only specific to people studying or PhD students. Avoid lifestyle creep. Now, what lifestyle creep is, as your income increases, whether you're getting more money as you transfer from sort of graduate to a postgrad, whether that's, from postgrad to sort of starting your career, your income naturally increase over time. It's very important that you're aware of your expenses so you can control them and you don't allow them to sporadically increase with your income. Okay. A lot of people, they start earning more, and as soon as they do, they start spending more. And because of that, they're unable to save what they need to. And that's how you end up, you're sort of 40, 50 years old into your, many years into your career, and you haven't got the asset space that you do have to sort of give you that financial freedom. And that's what we're trying to achieve. Now, with these basic habits, with these sort of foundations in place, this will set you up to build a strong financial plan. This alone is going to allow you to reduce any sort of stress that you feel. And, most people don't do a lot of these things simply because it's difficult to do it. It's sometimes scary to look at your budgets and start thinking about savings or automate things when you feel like you're already behind. So hopefully you're listening to this and you're sort of ahead of the curve. You haven't started to make some of the mistakes that we're going to cover later on in the presentation. Okay. Now, are there any questions or anything that we need to clarify? No, that's all good. So let's actually move on to investments and how we actually build wealth, because yeah, we can't budget our way there. Now, what actually is investing? So simple, to put simply, investing is putting your money somewhere with the expectation of getting more back. All right. When we look at generating wealth or building wealth and becoming financially free, it's very important that we invest our way there, because just simply saving, simply budgeting and tracking your finances, it's not enough. It's genuinely not enough, and we need to be able to allow our assets or allow our money to work for us. And we're going to clarify how exactly that works and what you can do. Some of you may have seen this chart that I've shown you before, but this is what people refer to as the markets. Okay, simply put, this is the S&P 500 index. And an index is a group of funds or a group of stocks and shares which create a fund. And essentially it tracks, the US 500, S&P 500 tracks the top 500 companies in America. And when we look at investing and investing into the markets, these are the things that people are talking about. Okay, we're talking about, are we investing into the into a tracker fund which will track the performance of the S&P 500. So over the last sort of 10 years, you can see how prices have changed. This big drop that we see here is COVID. This is the interest rate rises, and then if you're paying attention, last year Donald Trump's tariffs caused a 40% crash in prices. So we've just recovered and made all-time highs. You might think things are bad, but we're actually in pretty good times at the moment. But before we get into that, just there's two things you want to think about before you start investing. Number one, investment time. Okay. Sometimes you might hear this investment horizon or length of time of investments, but essentially, how long until you will need those funds that you've invested? Now, if you're investing for a house, you're planning to buy a house. You want to buy that house in 3 years. Your investment horizon is 3 years. Okay, so you'll be looking at things that are going to be giving you the profit that you need over that course of time. If you're investing for retirement now, retirement, essentially that's 30, 40 years away. You're going to be investing in something that can give you those kind of returns, or the returns that you expect over a longer period of time. Now, why investment horizon is so important is because it plays a big part in what your options are. If I'm going to invest and I need my money at the end of this year, so I need my money in December 2026, it's not going to make sense for me to buy a property, right? Because it's going to take me, 2 or 3 months to buy that property, and then maybe 2 or 3 months if I need to sell it. Properties are quite illiquid. So depending on what your money is actually going to be used for, depends what your options are when it comes to your investments. The second thing that's very important is risk appetite. Risk appetite refers to the level of risk you're comfortable with taking in your investments. Okay. And when you think of risk, think of how likely are you to essentially lose your money, right? So the more likely you are to lose your money, the higher the risk is. Now, what they do say is that you should invest in things that reward that higher level of risk you take. So if you're more likely to lose your money, it means you're more likely to make more money, essentially. In investment terms, when we talk about investments, risk actually simply refers to the volatility of your price of the asset that you're investing in. So if you see here, these fluctuations where price is moving up and down, that is what risk is. The more volatility you have, the higher risk the asset is. All right. Now, with these two things in mind, you've confirmed, okay, I'm investing for 5 years, or I'm investing for 10 years. I'm comfortable with X degree of risk. It then gives you a scope to choose what assets do I invest in. Now, there's loads of different assets to look at, and we're going to cover a few trends at the moment in the next slide. But just to kind of give you an idea, you've got 4 main asset classes. Okay, one is equities. When you hear equities, think of stocks and shares. So Amazon, Microsoft, Meta now, not Facebook, Netflix, Google, Alphabet. These are all stocks and shares that you can buy. This is what we call equity. You've then got bonds. You've got 2 types of bonds. Bonds can be corporate or government. Now, essentially, a bond is simply a loan that you make to a government or corporate institution, and in return, they will give you back a fixed set of interest and pay that back once a year or twice a year as a coupon payment. And then at the end of the period, they'll give you back your principal. Then the other 2 asset classes are commodities and alternatives. Commodities are natural resources, gold, silver, copper, oil. And then alternatives refer to essentially anything else. I'm not sure if any of you have invested in cryptocurrency before, but this is an alternative asset. Art, jewelry, wine, whiskey, these are all alternative assets that people invest in who essentially, these are sort of the higher risk assets that we look at. Now, what is interesting at the moment is there's 3 main sectors people are putting their money in, especially our clients that we're dealing with what's happening in the Middle East. it's created some opportunities for us. And if you're more of an ethical investor, i.e., you don't support companies that pollute with pollution, or companies that are earn their profits on war, you might be opposed to some of these trends. But the first trend, as you can imagine, is defense. Aerospace and defense, there's a lot of money to be made here at the moment. It's important that I tell you guys, this is not advice, this is not financial advice. Please do not just go and buy some defense stocks or aerospace or drone making technology. No, this is just information for you guys to keep an eye on and understand what investors are looking at. Now, why are we looking at defense at the moment? And we've been looking at it since essentially the Ukraine and Russia war. But a lot of money is now being invested into contracts, and this is globally. So we're seeing one incident actually causes other countries to say, actually, in case this spreads, let's make sure we're investing in our defense and we're safe, and our citizens are safe. So there's been a lot of money and a lot of returns made over the last few years in the defense industry. The next one, I hope a lot of you are familiar with, AI. AI has been a buzzword for the last, we can say, for the last 4 years now, actually. It's becoming more apparent with things like ChatGPT, Grok, and other AI tools that people are using. I don't know if people are using them for coursework, assignments, but these definitely are helping in our industry. And what that means is we're seeing a big increase in the prices of AI stocks and shares. So Nvidia, they're a well-known chip maker. They're one of the largest companies in the world right now. They've made over 200% over these last 2 years. Now, these are the kinds of returns that you can make when you spot these trends. So AI is definitely an area to pay attention to. Now, interestingly enough, AI companies are not profitable just yet. And that's because the energy it costs to power the software and to power the technology costs too much when compared to the revenues that they're making. But the companies that actually use AI and implement AI, they are benefiting the most, because AI can cost, AI is costing you quite cheap. It's not expensive to implement in your systems, but the efficiency that it improves and the efficiency that it allows your company to have greatly increases profit margins. The third the third sector that is really important and actually links to technology, as I mentioned, is renewable energy. So now we see there is a big trend of companies investing in renewable energy in order to find ways to produce energy cheaper, but more sustainably, because they realize that powering these new technologies, if we do so using traditional systems and traditional methods, we could end up in a position where pollution is greatly increased, and there's a lot of indirect costs that people are not aware of. And so now when we invest, and especially when combined with the sort of zero carbon emissions by 2030, now is the time to get in on the ground. But again, think about what companies would benefit from these trends. Think about how can we actually profit from this over 3 to 5 years' time. Again, these trends are not something that you might say, okay, yeah, it's going to take 6 months, it's going to take 1 year. Some of them may be, if the all wars cease today, defense is going to crash again. If new regulations come out and they state that actually we're not going to allow any development in AI because of security risks, that's going to crash. So you do have to think about the risk as well that go with investing in these things. Okay. So now you're in a place where you understand how to budget. You understand what you've got left over, what your disposable income is. You're saving. You're aware of your finances. You've got a basic idea of where to put your money, how to invest, what the markets are, what sort of trends there are. We're going to come back to literally practical steps, but I want you to take on board the importance of starting early, and I'm going to go through some numbers quickly to give you the significance and the difference of what small amounts per month can grow into over a period of time. And if you look at these three lines, so the blue line is £50 per month, the orange line, that's £100 per month, and the green line is £200 per month. So if you remember Jeffrey, he's saving £170 per month. After irregular expenses, maybe he's got £100 left. But we don't know, it might change from time to time. So let's say if we're saving £50 per month, he started 7 years ago, so he's 32, and now he started at 25. By the time he's 65, if he continues to do so, he would have saved £131,000. Now, over that period, the actual total amount he's invested is £24,000. So gaining or earning a return of 7% a year, with compound effect, he's able to generate £131,000. If he was saving £100 a month, at the end of that 40-year period, he would have had £262,000. Now, to put these numbers in perspective, the average retirement pot, the average amount of money that citizens in the UK have when they reach 65 is 344,000. Okay, so most people are retiring with 344,000 in their retirement pot, in their pensions, in their assets, whatever savings it is. And that is meant to last them for the remainder of their period. And they will get a state pension. If they've been working fully and paying the NI contributions, they will get a state pension also. Now, if Jeffrey only saves £200 per month, by the end of, or by retirement at 65, he can expect 524,000. So starting small is not a problem. If you were thinking that, I don't have enough to start, I don't have enough investments, saving £50 a month might not seem significant now, but I can assure you, after 5-10 years of consistent habits, you will see that that really actually puts you in a position where your money is now making significant differences. And who's going to assume that you can only save £50 per month? What happens is actually you might start with 50, but after 5 years now you can do 100. After another 5 years you can now do 200, and that significantly improves what you can expect to retire with. Also, as important as starting early is when you start. It's starting early, sorry, not just the amount, but when you start. Okay, so now the difference of starting at 25, which we just looked at, and there's and 10 years later you're 35. Okay, you've invested the same amount, so still £50, £100, and £200. But instead of 131,000, which you would have had if you was started at 25, you started 10 years later at 35, and you now have 61,000. Okay, you've only waited 10 years later, and this is the difference that it's made. If you started at 35 and you started with £100 per month, you've got 122,000. If you started with £200 per month, you've got 244,000. Now, I've just told you that the average retirement pot in the UK is 344,000. So if just simply starting with a smaller amount 10 years later can significantly decrease your retirement prospects, or what you can expect to what lifestyle you can expect in retirement. Okay. We don't expect people to, start immediately, start small, but I just want you to look at these numbers and really take on board the importance of the earlier the better, and it doesn't matter how small you start with, it all adds up. What are the common mistakes that we see? So why is it, people struggle so much with finances? Why is it that there is so much financial stress? And I think that there's many reasons, many things affect this. You've got all sorts of spirit. We spoke a little bit about my background, and one of the problems I had to deal with is dependence. You grow up in a culture where you actually start to make money, and you might have children, but you now have parents to take care of, family to take care of that most other people in different cultures wouldn't have to. And you've got a lot of pressure, a lot of social pressure to maintain a certain lifestyle and look a certain way. And these things all impact your financial stress. One thing that I found really helps is the fact that I'm aware of my finances, and it allows me to really say, actually, no, I can't go there, can't do this. It allows me to make sure that I can actually understand what decisions will be good for me. But looking at just the common mistakes, that's something really that's more of a personal story, and some of you may relate to that. But the most common mistakes are people investing money that they need. Remember when we spoke about investment horizon? When is it? How long do you need that money for? Don't invest money for 3 years that you may need in one. Okay. The reason being is if you do decide to invest that money and 1 year later the markets are still down, markets haven't moved in the direction you needed because you invested in assets which were expected to have, sort of, you thought, okay, after 3 years they'll be doing well. You've now had to sell those assets at a loss. That means you've lost money simply which could have been avoided. You may as well have kept your money in cash. The second one, chasing excitement. This is why when we went through investor trends, I was very careful to let you know that do your research, understand what you're investing in. Don't just invest in defense because it's exciting right now. There's a war going on. Oh, look at me. Yeah, I bought defense stocks. Let's not just invest in AI because it's doing well right now. Let's really understand what AI is, how it's going to benefit. Is this somewhere where I'm going to be comfortable keeping my money in? When we chase excitement, many people lose money. There was in COVID times, I don't know if some of you remember this, in COVID, everyone was investing in cryptocurrencies. It was crazy. New coins coming out here, there, and everywhere. My dad was telling me to buy this. My friends were coming to me telling me to buy these stocks. I was so confused, but everyone was excited. Now, I don't hear any of them. People have lost a lot of money due to them. They were just chasing excitement. And finance, good proper finance is boring. Saving £50 a month for 40 years is boring. But you do those things as your foundation because that time is going to pass. So if you don't do it, you're going to end up, 40, 50 without those funds there when it wouldn't have cost you much to do it. What's £50 a month for most people after they start working is reasonable. The third thing is procrastination. Procrastination is, forget about finance for a second, right? Procrastination is the biggest killer of dreams. Excuse my dramaticism, but procrastination is the reason most people don't get anything done. And whether they call it lack of motivation, whether people are unsure where to start, or whether they genuinely don't have the time, so, but not getting started and not doing these things, not researching it is a big mistake I see. And the reason that I want you to understand that is because I speak with people who are 40. They've got pensions that they don't even know about. They're looking at retirement and they have children and they're not sure how they're going to be able to maintain their lifestyle. Delaying these matters of finance and personal and investments only make things harder down the line. You need to take your time to learn these things. Really understand so that you can take care of your responsibilities, and really manage your finances in the right way. And so I want to kind of leave you guys with this, and I want to leave you with some practical steps that you can take with you to really look at, after this, kind of write down really write down these steps and take notes here so that you can walk away from today with a plan and an action to take control of your finances. So, challenge number one, track your spending for 30 days. Okay, so we're coming up to we're 2 weeks away from the end of March, but for April, I would say starting of April to the end of April, track your spending. What is it that you have coming in? What is it that I actually earn every month? You want to be very clear on that. How much are you spending in each area? So when we speak about budgeting, understand typically what is it that you spend on travel? Don't just guess. What is it that you spend on eating out and food? What is it that you need actually for your bills? Do you need to do a certain amount of shopping every month, etc.? Really understand what you need so that you can now focus and actually decide, okay, based on my lifestyle, based on what I need, I actually need to earn more money. I need to get more money from somewhere. Or based on my lifestyle, actually, I can reduce certain spending here. I can actually save a lot more. Once you're aware of that, the next thing is take some time to research some of the concepts that we spoke about. Now, the first concept that you really want to understand is, I mentioned funds, right? I mentioned the S&P 500. I mentioned, equities. I understand what an exchange traded fund is. An ETF. This is where you're probably going to be making your first investment in. What an ETF is a group of stocks and shares. When we speak about earning that 7% return, that's typically what you can expect from that per year. And it's just a fund that tracks the global equities market. So it invests in, it will invest in over 3,000 stocks and shares. It will be diversified, but it just tracks the global economy. So you don't have to pick any stocks or worry about any trends. You just need to worry, okay, my money is invested in the markets. When the economy grows, so will my money. It's as simple as that. Once you've got a good understanding, the second thing, how you're actually going to do this is through a stocks and shares ISA. So some of you may have heard of a stocks and shares ISA before. For those who haven't, a stocks and shares ISA is an investment account which you can open up with Trading 212, Hargreaves Lansdown. There's many brokers on there. If you just Google, you'll see stocks and shares ISA. You're allowed to put £20,000 per year into this, no more. And the benefit of this type of account is that your money grows tax-free. So that £50 a month that you're investing, if it grows to 131,000, that will all be tax-free. So there's no capital gains tax, there's no dividend tax, there's no interest tax. Now that's important when you grow your funds. You want them to grow in it. You want to keep, when I talk about efficiency, you want to keep as much of these funds as possible. So the stocks and shares ISA, you open a stocks and shares ISA. You then set up a direct debit into that stocks and shares ISA. So whatever you decide after you've tracked your 30 days of spending, you now understand what your disposable income is. You get a stocks and shares ISA. This is going to allow you to set up a direct debit for whatever you can. If it's £50 a month into there, no problem. If it's £20 a month into there, no problem. You would then invest this into an ETF, a global ETF. And, I'll be happy to, if anyone comes back with questions, I'll be happy to look at some basic recommendations on actual what investments to make. And get started. Okay, start small, if and when you're ready, but implement what you learn. It's so important. It's so important. There's a quote that I actually learned when I was younger, and it says, "The man that doesn't read is no different to the man that can't read." And it's the same, and it's all about action. You're no different to someone that doesn't know how to do anything if you actually don't do it. So with the knowledge that you have, make sure you apply it, and so that you can, take your personal finances to the next level and really start to take control of where you are. Um, yeah, there was no questions throughout, but if there are any questions now, I know what we've spoken about is there's been a lot. It's been quite technical, so I hope you've managed to stay with me through that.
Yeah, thank you so much, Sharif. And just as a reminder, guys, this session is recorded, so you will be able to catch up on YouTube. I can circulate that link after. I know that there were a lot of new terms for a lot of us. But thank you so much, Sharif. If anyone does have any questions, feel free to put them in the chat. I see someone's got their hands up. I'm going to be a little bit rude and just ask my question first. So you did mention about the compound effect, and I hadn't actually seen any numbers regarding the amount of money that you put in every month and the relation to the amount of years. I hadn't realized that at the age of 25, if you're putting in £200 a month, you can get half a mil versus a quarter mil if you start at 35. That's a big jump. On your first
Exactly.
slide, you spoke about, of course, investing. You also mentioned building an emergency pot. So just to clarify, do you recommend building that emergency pot first and then moving on to the investing?
Yeah, yeah. So definitely make sure you've got that emergency fund. That is what's going to allow you to invest without having to touch your investments. So you don't want to invest and then start thinking about, oh, do I need that money and taking the money out?
That's a good point. We have a question in the chat. You talked about investing for the goal of retirement, but what about investing for shorter term goals, e.g., saving to
Mm.
buy a car, house, relocating to a new country? Can you do a follow-up webinar on investing for PhD students? I mean, we can
So
always do a follow-up webinar as long as Sharif is happy to do that, but I can let him answer the first part of that question.
yeah, that would be fine. So when you're looking at investing for shorter term goals, short term we would see as 3 to 5 years. So anything under that is short term. Medium term is 5 to 15 years, and then long term is 15 years plus. Now, how you invest for shorter term goals, ideally, you just want to save into cash if it's really short term. So you're looking at 1 year, anything under 1 year, definitely don't invest. If you're looking at 2 to 3 years now, you might want to look into bonds. So remember, I spoke about bonds, which are loans to governments or corporations, and in return, you'll get a sort of set amount of interest. Typically, the rate of interest that you get for these products is higher than what you would get for saving your money in the bank. That's why we recommend them. And you can invest in those products via your stocks and shares ISA.
Thank you. Do you want to ask your question?
Yes, I just wanted to see your personal thoughts on pensions. Do you think pensions are worth investing in, or do you think you're better off investing your money in stocks, shares, ISA, or cash ISA, as opposed to that? I know they also self-invested pensions as well. Do you think that is also a better option than pensions with a company?
Yeah. So, very good question. Now, your private pension, so a self-invested personal pension or SIP, essentially you have more control over that than the pension you have with your company. Okay, so they tend to give you more access to different investments, which is good if you know what you're looking for and you know what to choose. What we do as financial advisors is we help clients make that choice because your workplace pension, you won't have access to the whole of market. You would only have access to what your company provides you with. Now, to answer your question on whether your pension is worth investing in or the stocks and shares ISA, it depends on your tax position. So if you are not paying any tax, or sorry, let me start with saying this. The main benefit of a pension is that you don't pay any income tax on money that you put into your pension. Okay, so if you're earning £30,000 a year, you'll be in the basic rate tax. So you'll be paying 20% of tax on some of your income. Now, if you put that income into the pension, the government gives you back that 20%, so you don't pay tax. Whereas if that went into your stocks and shares ISA, you wouldn't get that back. You would have to pay the tax. So that's the main benefit of pensions, is really about avoiding income tax.
And I guess also the idea of it being matched by your employer. Of course, if you're paying into your ISA, no one is necessarily matching that in the same way. Do you have another question?
Yes, because you said the difference between a regular pension and a self-invested pension is the amount that you can actually invest in, whereas with your employers, you do not know what exactly they are investing in for you, right? But and then you
Is what you
said
can
that,
invest in.
sorry?
Is what you can invest in.
Yeah, what you can
Yeah,
invest
yeah.
in, yeah. But if would you say that your employer's rate percentage of how much they put in would be higher than a self-invested pension?
It depends what you choose. Typically, if I were to, do I manage my own pension or do I let my company do it? I know what I like to invest in and what investments are out there, so I manage my own. But if you're not sure what you're doing, then I would recommend you leave it with your company. Now,
Okay,
the reason being is because employer pension schemes, they're not designed to make returns. They make returns, but they're designed to keep your money safe and
okay.
designed so that by the time you reach retirement, your money's there and it's grown. Whereas what my job is to generate returns, right? So when we're looking at investments, we're here to maximize growth.
Yeah. Oh, okay. Thank you so much. That makes a lot of sense.
No problem.
If anyone else has any other questions, feel free to put your hands up, put it in the chat. I have another one. We have spoken a lot about generating wealth, but what about credit? How can we begin to build credit at this stage or improve the credit we already have?
When it comes to credit, actually, it depends on what you're looking for credit for. So most people are under the impression that they need, high levels of credit, high credit score to buy a house. But the reality is, as long as you don't have any bad credit, you're pretty much always going to get accepted for a mortgage because that type of loan or that type of asset is backed by a house. So the bank don't care about, as long as you have shown decent history in making payments, or if you haven't got any, they know that if you don't pay, they will take back the house. But typically, the best way to build credit is a phone contract. I know it sounds basic and simple, but completing a phone contract, it really does improve your credit score. It shows banks that you've got, good habits, you're not missing payments. And as soon as you complete any contract, whether it's 2 years, 3 years, your credit score increases.
So I guess in that vein, then the most important part of your credit is you not missing payments as opposed to the actual credit score. That's very
The
interesting.
most important part, yeah. The most important part is not missing payments. As long as you always meet your payments on time, you won't have a problem.
Yeah. We have another question. Can you transfer a company pension to a self-invested pension?
Yes, you can. So you can transfer. Well, it depends on your provider. So 90% of the providers, so whether it's Aviva, Scottish Widows, and just for those that don't know, providers are essentially people that give you the pension. But depending on who your preferential provider is, depends on whether you can put it into your self-invested pension. One company I know that don't do it is Nest. Unless you leave your current employer, Nest will not allow you to transfer into your SIP.
In that same vein, I think in this modern day, it's very common for people to jump between different jobs. So you end up having a lot of different providers. Do you know of one way to be able to unionize that, or do you have to kind of individually contact each of those providers you've had from the different jobs to kind
Yeah.
of cover all of your pensions?
So that is actually a big problem that we have. So it's actually a big problem that we have in sort of the investment world is that people change jobs, they lose their pensions. There's no centralized database for all your pensions. So you need to be keeping a track on who was your pension with during your employment. And then as you move companies, you either transfer it from your old provider to your new one, or you have a self-invested pension where you put all your old pensions into. Um, Chuku says, I've got a pension with Scottish Widows. I left the employer, but my pension is stuck. So I was wondering if I can place it in one. Yes, so you can. So with Scottish Widows, since you've left them, you will definitely be able to put that into a self-invested pension. You will once you set up a new self-invested pension, let's say you use AJ Bell, Fidelity, or any of the new providers where you can manage it. They will have a transfer form which you can fill out and move across.
Right, and we have a hand up from Omoge.
Hi, Sharif. Thank you. It's a
No
lovely
worries.
presentation. Um, I wanted to ask about starting your stocks portfolio as a beginner. There's a lot of
Mhm.
information out there, and a lot of it kind of pushes you in different directions. Some people say completely safe investments, just get an ETF and be done with it. Some others are like, no, you have to invest in Nvidia and tech stocks and so it's all of this information. I was wondering, do you have a recommendation for beginners in terms of how should you structure your portfolio? What percentage should be safe stocks? What should be more ambitious? Where do you kind of
Mhm.
start from choosing what to put your money in at the beginning?
Yeah, great, excellent question. Now, this comes down to depends exactly who you are. I'm sorry to say this, but there's no one size fits all scenario, you know. For those of you who are happy to take a risk, you're investing for a longer period, I would recommend you should be happy to start with 100% equities. You don't need that money. You can invest in all stocks and shares. I don't recommend you invest in individual stocks, so definitely stay on the ETF side until you have a better understanding of valuing stocks or better understanding of the direction and trends of stocks. You start with ETFs, and then as you improve your knowledge and as you become more comfortable with investing, you then can start to add more risky assets into your portfolio. On the other end, if you're a beginner investor and you're worried about losing your money, you want to play it safe, you would still start with ETFs, but then I would recommend you add bonds into the portfolio. So the same way you can have an ETF for equities, stocks and shares, global markets, you can have an ETF for bonds. So, and for those of you that don't know, that's just a fund that invests in a group of bonds which are government and corporate and give you essentially lower risk. Does that make sense?
Yes, it does. I do have one second throwaway question, if you don't mind,
Yeah.
which is do you recommend investing in the UK, like UK stocks and UK shares? Because all the information I see outside says invest in the US, and I feel like that country is about to blow up in 2 minutes. But hey, that's just a personal opinion. Do
You
you
see,
recommend
yeah, let's
investing in
see.
UK equities and shares?
So let me actually look at something with you now. And now, I'm just going to show you some different chart. Is my screen still sharing, by the way?
Yeah.
Yeah, perfect. So what we're going to be looking at is just the prices of the UK. So you mentioned the UK, right? So in the UK, the index that tracks those stock prices is the FTSE 100. Now, the FTSE 100 has, taken, oh, sorry, let's look at this chart. Yeah, naturally all the markets are down because of what's going on with oil, but it has done really well over the last couple of years. Okay. Now, this is just because they're investing a lot more and they're trying to stimulate the economy. Now, would I say, I would never say yes, invest in a particular country. I wouldn't say yeah, invest in the UK or invest in the US. What I take the view on is you want to invest in a global tracker such as, uh, the FTSE World Index. Okay, so this is an index that tracks global stocks all over. So you've got Chinese stocks in there. You're gonna have English stocks in there, UK stocks, American stocks, emerging markets. So some of the stocks will be in Asia, France, Europe, and essentially there's a principle that these funds have, and I call it a self-cleansing principle. And what that means is that as a country's investments grow, more of your capital will be allocated that country. So, and then on the other end, as a country's economy decreases, less of your assets will be allocated to that country. So essentially, you follow the trend. All right. We're not here to try and decide on do we know if the UK is going to outperform the US. We can't predict those things. What we can do is actually, as countries improve, as their stocks and shares value rise, let's invest more money there as that trend increases. Okay. So one country that a lot of people missed out on. This is the Indian index, the Nifty 50, right? And over the last 5 years, it's made phenomenal returns. And because people are so focused on the US or the UK, they miss investments like this. So it's very important to keep a diversified approach so you don't sort of miss out on any particular country.
That's very, very helpful. Thank you.
No worries.
All right. Thank you so much for coming, everyone. And thank you, Sharif, for taking us through that and answering all of our questions. Like I said, I'll circulate the link for YouTube after. But that is now the end of our webinar, just basically 2 minutes ahead of time. So yeah, thank you all for attending, and hopefully we see you at some of our in-person events until the weather cools down, and then we'll be back online for more webinars later this year.
Yeah, I'll be at the Sip and Paint, by the way. So if you're coming there, we can have some questions. All
All right.
right.
Have a good evening, everyone.
Take
Bye.
care. Bye.